let's now take a look at a real-world example lease with incentives. Here you can see that on April 3rd, 2026, Precision entered into a new lease for warehouse space in Denver. And Section 2 states that the lease commences on May 1st, 2026 and expires on April 30th, 2029 for a 36-month term. Then for the first year of the lease, our rent payment will be $12,000 per month. In the second year, $12,360 per month. And in the third and final year, $12,730 per month. Then you can see to take possession on May 1st, 2026, we'll need to have executed the lease and paid the first month's rent. So as we've seen before, we'll pay that first $12,000 payment prior to lease commencement. Then you can see that this lease does include an extension option for one additional 36-month period. But let's assume at lease commencement we are not reasonably certain we'll exercise it. Then in Section 6, we now know these CAM charges will be treated as variable lease costs because they are not known at commencement, but we've elected to combine lease and non-lease components for our building assets. Then in Section 7, you'll see the focus of our episode here. This lease includes a tenant improvement allowance. We'll go through the rest of the lease and then come back to that one in a second. Section 8 states that we pay all utilities directly, so those will fall outside the scope of ASC 842. Then there's really nothing else here of note. Similar language to what we've seen on insurance, use of the premises, defaults and remedies, and finally this is the entire agreement of the parties. So we have a lease, it's all one component. And let's quickly fast forward through the incremental borrowing rate and classification analysis. We'll say our incremental borrowing rate is 7.5%, and after working through the 5 classification criteria, we determine the lease is an operating lease. Now if we turn back and look closer at the tenant improvement allowance in this lease, it states that the landlord will provide a total allowance of $75,000. Funded with a $25,000 upfront payment to us as the tenant, and the remaining $50,000 reimbursed for qualifying costs. That $50,000 payment, or less if our improvement costs are under $50,000, will be made as a one-time payment in month 12. So we clearly have a lease incentive here that we need to account for. These are direct payments from the lessor to the lessee. But in this case, some of the incentive is paid up front, and some after the lease has commenced. And as we discussed in the prior episode, incentives received before commencement reduce the right of use asset directly, while incentives received after commencement reduce the future lease payments, which will in turn impact our initial lease liability. Now before we enter this lease in our workbook, this does bring up a couple of questions to think about that relate to lease incentives. First, how does a construction period for leasehold improvements affect the commencement date of the lease? Is the asset available for us to use prior to construction? Or is it only made available once the leasehold improvements are complete? ASC 842 does provide guidance on this. Paragraph 842.10.55.21 states in part that there is no distinction between the right to use an underlying asset during a construction period and the right to use that asset after construction. It further states that lease costs or lease income related to ground or building leases that occurred during construction should be recognized by the lessee or lessor in accordance with subtopics 842.20 for lessee guidance and 842.30 for lessor guidance. So as long as the contract provides us with the right to use the asset during construction of the leasehold improvements, we include the construction period in the lease term. And our lease does exactly that. It states that the term begins on May 1st, 2026, and that the tenant accepts the premises in its as-is condition. We can improve the space, but any improvements occur during the lease term. Now, a second question related to these incentives involves the timing and certainty of payment. In our example, the situation is straightforward. We received $25,000 prior to commencement, and up to $50,000 in month 12 after commencement. If we can conclude that we are reasonably certain our first year improvement costs will meet or exceed $50,000, then we effectively know both the amount and timing of the $50,000 payment. But what if the lease were structured differently? What if the $50,000 after commencement were paid as monthly reimbursement based on actual improvement costs? Well, in that case, the incentive becomes contingent because the timing and amount depend on future events. And ASC 842 does not address this scenario directly. The standard does not provide guidance on incentives that are not paid or payable at commencement, and that instead depend on future conditions. As a result, different approaches have developed in practice. For this example, we'll assume we are reasonably certain to exceed $50,000 in improvement costs, which means we know the timing and amount at commencement. But if you'd like more detail on how contingent incentives can be handled in practice, we have a supporting video that explores this topic further. With those concepts established, let's track this lease in our workbook. We'll add it to our list. The identifier will be 5.0. We'll call this the Denver Warehouse lease. The trigger is a new lease. The asset type is building. The initiation date is April 3rd, 2026. The commencement date is May 1st, 2026. The termination date is April 30th, 2029 for a 36-month term. The incremental borrowing rate we've said is 7.5%, and this is an operating lease. Now we can copy a schedule template. We'll use the 2.0 lease since that was also an operating lease. Rename this 5.0, update our identifier, then let's clear out the payment information and the right of use asset information, and we'll adjust the schedule to 36 periods. Now we deleted the reference of our check formulas, so let's just update those now. For the lease expense, we want to look for the cumulative lease expense in our 36 period, and for the total cash payments, the cumulative cash payments, also in our 36 period. Okay, now that we have a blank schedule, we can add our payments. For the first year, our payments are $12,000 per month paid in advance, and our first month's payment is made before commencement. For the post-commencement schedule, payments begin on May 2nd, 2026, and end on March 31st, 2027. That gives us 11 payments of $12,000. Then from April 1st, 2027 through March 31st, 2028, our payment is $12,360. And finally, from April 1st, 2028 through March 31st, 2029, our payment is $12,730. That'll give us 35 post-commencement payments. Let's now add the $12,000 prepaid payment to our right of use asset. And I didn't see any additional prepaid items in the lease. And let's assume that we handled finding this warehouse internally. We didn't pay commissions or anything like that in connection with this lease. Now though, let's determine our lease incentives. The $25,000 that we received prior to commencement is straightforward. We'll add a row to the right of use asset section labeled incentives received from lessor and record this amount as negative $25,000. This immediately reduces our opening right of use asset. We'll also need to reduce the total consideration paid under this contract for this incentive. So let's subtract it from the total lease payments now. So we'll add this cell because we've added it as a negative cash outflow. And you can see now prior to commencement, overall, we'll actually have a cash inflow of $13,000 as the lessee, which includes the $12,000 we'll pay to the lessor and the $25,000 we'll receive as a lease incentive. Next, we need to add our post-commencement incentive. Since we're reasonably certain that we will exceed $50,000 in qualifying improvement costs, and the contract states that this amount will be paid at the end of the 12th month of the lease term, we'll enter a date of April 30th, 2027, with an incentive amount of $50,000. And just like in our right of use asset, because this is a cash inflow to the lessee, we'll record it as a negative value. We could record these lease incentives in a separate section and a separate column on our schedule, but I think it makes sense to simply place the lease incentive in our payment schedule. ASC 842 defines lease payments in part as fixed payments less lease incentives, so we're following that structure. Now the incentive amount is greater than the monthly rent, which results in a negative payment for the month of April 2027. That may look unusual, but it is correct under ASC 842, because the lease payment for that period is the fixed payment less the incentive. And in April 2027, between the lease payment to the lessor and the incentive received from the lessor, Precision Industrial will actually experience a cash inflow related to the lease in that month. Now the last thing we need to do on our schedule is adjust our operating lease expense for the pre-commencement incentive. You can see in the very bottom right hand side of the screen right now, at the end of the lease term, our right of use asset is not zero. That's because just like in the right of use asset, we need to add this to our operating lease expense. So let's do that now. We'll add a row. We'll also call this incentives received from lessor and link back to our amount in the right of use asset. And now you can see that will reduce our straight line lease expense during the period. And once we've incorporated that, our right of use asset is amortizing to zero over the life of the lease. And finally, our check is telling us that the total lease expense we recognize over the life of the lease will match the total cash consideration paid under the contract, just as we'd expect. So now that we have our schedule built, we can add our periodic journal entry for this lease. We'll copy down this 2.0 lease since both are operating leases. Then we'll update the identifier to 5.0. Update our formula references from the 2.0 worksheet to the 5.0 worksheet. I've also separated this building lease account in our accounting system. Again, you probably wouldn't do this at your own company, but it makes it easier to illustrate for our purposes here. So this will be account 2300-0100, and it's building lease current Denver, then 2600-0100, building lease long-term Denver, and finally, our accumulated amortization account is 1400-0101. And it will be accumulated amortization building right of use assets, Denver. Then before we enter this in our accounting system, let's preview what we'll come across in that month we receive the incentive, April 2027. Remember, in that month we have a net cash inflow because we pay $12,360 in rent and receive a $50,000 incentive. That results in a net inflow of $37,640. The workbook calculation presents the clearing of our clearing account as a negative credit, which, as we've discussed previously, we'll interpret as a debit. So when entering the journal entry into the accounting system, we'll manually flip the debit or credit as needed. So let's go enter this lease now. First, we'll assume we make our first $12,000 payment in advance on April 27, 2026. So we'll debit our prepaid lessor payments and credit our checking account. And you can see we've now recorded that prepaid lessor payment. Then let's also assume the lessor remits the pre-commencement incentive to us on April 29, 2026. So we have another journal entry here. This time we'll debit our checking account for the $25,000 incentive we received, and we'll book this to a liability account called Deferred Lease Incentives. So if we save and close, you can see in our current liabilities we now have this deferred lease incentive for $25,000. Now on lease commencement, our accounting team will make the initial measurement journal entry. So this will be on May 1st, 2026. We'll credit our current lease liability for $73,577.95. We'll credit our long-term lease liability for $268,654.31. We'll credit our prepaid lessor payments for $12,000. Debit our building right-of-use asset for $329,232.26. And finally, in this instance, we'll need to also debit our deferred lease incentive to absorb that pre-commencement incentive into the right-of-use asset. And if we save and close, as of May 1st, 2026, you can see our prepaid lessor payment is now cleared. We've recorded our Denver building right-of-use asset. We've cleared our deferred lease incentive, recorded our Denver building lease current liability, and our Denver building lease long-term liability. And with that, we've covered the concepts of lease incentives as laid out in ASC 842, and recorded a lease that includes both pre- and post-commencement incentives. In the next episode, let's begin to look at residual value guarantees.